Good afternoon, friends. This is Mataprasad Pandey. Today, I would like to share my key observations on MPC announcements as made on 8th of February 2023. Like in my earlier audio note, I had talked about the long pause by RBI and the reason behind the same. Now, post this policy outcome, I would like to stick to my view. Among key observations regarding MPC announcements, I would begin with CPI projections. Regarding CPI projection, inflation projection for the next year across the quarters have been 5% and above, and reaching as high as 5.6% in Q4 FY 23-24. If we go by the RBI's commitment to bring down inflation towards 4% by 2024, this inflation projections doesn't support that target somehow. Secondly, annual inflation figures looks so low optically at 5.3%, but which is also majorly due to the drawback of averages theory. For example, if the inflation projections had moved in a reverse order, that is not from 5 to 5.6%, but 5.6 to 5%, still average would have been 5.3% in this case, but that would have been more satisfactory and logical to the market, as inflation trajectory in that case would have been moving in a downward side along with the annual inflation number. Now, post this policy, there are fresh concerns and renewed discussions over whether there will be 25 bips rate hike more or there will be a pause after this. Experts have different opinion on the same, and I would also like to share my view on this. 25 bips hike cannot be presumed simply out of an assumption, but should be supported by the facts and figures. 25 bips hike can just be a probability. Most of the people only talking about persistent high inflation, including core inflation. But in my view, there are other key factors as well besides inflation. It's not just about inflation issue, but also an issue of interest rate differential between US and Indian bond market, which continues to be very low. And the effect of the same can also be seen in FEI participation into Indian bond market, which has come down to 25% from 75%, which was pre-pandemic level. And secondly, it put pressure on Indian rupee, which anyways has depreciated against the dollar. Rupee depreciation has significant negative impact on our economy. Rupee depreciation leads to FI outflows, which is negative for our stock market. It also affects our trade deficit because we are the net importer, impacting the CAD and then thereby impacting the fiscal deficit. It causes the imported inflation. Low interest rate differential, as discussed earlier also, it leads to the lower FEI participation into Indian bond market. So in a nutshell, besides high inflation, there are other key factors as well as mentioned in this note. RBI would have to make a note of this before taking any decision in the next policy outcome. US Fed still continues to be committed to bring down inflation to 2%. The recent release of non-farm payroll data, which actually surprised the market, as number was far ahead of the market expectation. Hence, looking at the current stand of US Fed, it seems they might have to continue to hike rates, and in that case, RBI will have to act. And in order to protect Indian rupee, they may have to hike rate. So it not only depends on the inflation, but also above mentioned key factors. Hence, there is a probability, and also depends on the situation we are into at that time. Though probability is very low, but it is there. We cannot rule out the same. Hope I could put across my points in a simple and easy to understand language. Thank you so much, and I will keep sharing my view and thoughts in my coming audio note for better understanding of my listeners. Thank you so much once again.